Hello and welcome to The Note. We're going to be talking about smart beta today. Fascinating group of new strategies that aim to weight market indices by factors other than market cap and find ways steadily over time to beat the indices. It's an impressive strategy so far. There are many different versions of this that have yielded results, but there are also increasing criticisms of it, even from some Nobel Prize winning economists. So I'd like to put some of those criticisms today to the founder of one of the main providers of smart beta. He's the founder of research affiliates, Rob Arnott. Rob, thank you very much for joining me in London today.
Privilege.
Let's start with Bill Sharp, the Nobel Prize winning economist who largely invented the term beta, has said that he finds the term smart beta sickening. What do you mean by the term smart beta? How would you define it?
Well, I think smart beta would be any method that is disciplined, objective, and deliberately severs the link between the price of a stock and its weight in the portfolio so that a stock rising in price doesn't automatically carry with it a higher weight in the portfolio. The definition has been broadened because it's such a popular idea to embrace anything that's not cap weighted. Okay. And that's way too broad a definition to have any meaning at all.
Okay, but the core intuition is that it's something very systematic that isn't directly tied to market cap. Now let's take a look. I'm sure your marketing department will be delighted to see this one. This is the results of your main flagship US fund since inception compared to the main ETF for the S&P 500, which is market cap weighted. Obviously, it's worked very well so far.
Yes.
Could you explain briefly how you choose your weighting for the stocks in that index?
Certainly. Basically, what we do is weight companies in accordance with their aggregate economic footprint, not their size in the stock market. So think of it as an index that's weighted to mirror the look and composition of the macroeconomy. You can measure the size of a business using any of a number of measures. You can measure it using sales or profits or book value or dividends. Any of these is a perfectly good objective measure of the size of a business.
Right.
But none of them is necessarily directly linked to market cap, hence to price. Now, if you weight companies according to their economic footprint, we use a blend of the four measures. If you weight it according to its economic footprint, then if a company lofts to a very high multiple, we'll reweight it down to its economic footprint. If it tumbles deeply out of favor, we'll reweight it up to its economic footprint. So we concentrate against the market's most extreme bets.
Okay, so now let's take a look at another chart which comes from your research. To some extent, you're always deliberately selling winners and buying losers.
That's exactly right. And that's the heart of how it adds value. It's not that it has a value tilt.
It tends to buy stocks when they're cheaper.
Right. But the way it really adds value is not so much through the value tilt as through the trading. You're always you're always reducing exposure to the companies that are most beloved.
Right.
And you're always buying exposure to the companies that are most out of favor, feared, even loathed, and hence very cheap.
Okay, now, how long can this carry on working? To channel Bill Sharp once more, his great complaint is that smart beta, if it's going to continue to work, needs to rely on the continuing dumb beta, or maybe dumb alpha, i.e. you need to keep relying on other people to get on the other side of these trades. If everybody works out that this is a good way to invest, aren't the advantages going to go away?
Absolutely. If everyone embraces the idea, the market will become fundamentally weighted and the alpha will disappear.
So you're rooting for stupidity at this point, which may be quite a safe thing to be rooting for.
I think it's a very safe thing to root for. Who's on the other side of our trades? People who love to buy recent winners, people who are scared of losers and liquidating them. If people continue to love growth, to chase momentum, and to love owning companies that are highly popular, as long as those people are legion, and they'll fund the success of a strategy that takes the other side of their trades. So I'm not worried about this being arbitraged away in my lifetime.
Okay, Rob, thank you very much indeed. I'm not sure whether this is good or bad news, but I have to agree with Rob that I don't think this is going to be arbitraged away anytime soon. and that betting against the dumb money is probably going to be a strategy that works for a long time. One point on which I think he does agree with Bill Sharp commented on this, says that it would be a bad world if there were no longer any more active managers. Nobody would be trying to bet against the market's inconsistencies, but human nature means there will always be people out there who try to bet on active management.